What's going on, guys? It's Jonathan Smith. I want to come to you today with 3 ways to buy your first property. Now, this doesn't cover every single different way that you could buy a property because there's a lot of cool creative financing. These are just the most common ways you're going to come across as you start learning how to buy your first investment property. So, the first one is going to be the easiest way, and it's the way that I find a lot of people get started. A lot of people, when they're looking to buy their first investment property, have actually already purchased their own primary residence. So the fastest, easiest, and sometimes the best way to get started in real estate is to just make your primary residence into a rental. So what does this look like? Maybe you bought your first house with a VA loan, USDA loan, FHA loan, really low percent down, 0%, maybe 3.5% down. Take that property and you have the really low interest rate on it, keep it, and just buy another house, move into it, and then rent out your primary residence. That, for a lot of people, is going to be the easiest thing to do, and you're going to have really good financing. The interest rate's going to be really good. So that is way number 1. Number 2, you have the option to buy the property as a traditional rental property loan. It's a loan where you pay anywhere from 15 to 25% down. You maybe get 0.5% to 1% higher rate because it's an investment property. And you buy a property that either has tenants in it or you could easily put tenants in there. I've heard of people buying new construction because they know it's all brand new construction. They don't have any issues. They put a 25% down and just rent it out right when they purchase it. Maybe you're buying from a landlord that's getting ready to retire. So you already have a tenant in place. Maybe they've been there for 5 or 10 years and you expect them to continue going. So you put the down payment and then you make the payment every month and they pay their rent and everything's all good. That's a very, very common way to do it. Now, the third way to do it in this video, of course, is with more of this is going to be the most risky way to buy an investment property, but you have the potential to have the highest reward. And it's one way that I've really been able to accelerate some of my purchases and building equity. Now, what you're going to do, a lot of people call this the BRRRR method, and that stands for buy, rehab, rent, refinance, and repeat the process. So you can go out there and find a house that is in distress. It needs a lot of work. We're thinking things like maybe the roof needs to be replaced. There was a plumbing leak. There's the floors are all messed up. Tenants were in there and they treated it real poorly. Landscaping's looking real bad. I mean, you're just talking about those ugly houses that probably sit on the market for a long period of time. Or maybe you find something off market and an owner just needs to sell it today. And what you're going to do is you're going to figure out how to buy the property with either a hard money loan or a personal loan. Hard money being a little bit easier to get to because these lenders are everywhere, or a personal loan, maybe someone that has cash that they want to invest and you can offer them a pretty good interest rate on it. These loans are usually anywhere from 10 to 20% down depending on your credit score and if you have any experience in this, and you're probably paying anywhere from 8% to 15% interest rate, so it's definitely a lot higher of an interest rate. But you buy this property, you do all the rehab to it. Let's say you buy a property for $100,000. Property needs $50,000 worth of work. But afterward, it might be worth $200,000 to $225,000 because you've brought it up to living standards, you've replaced the roof, all these different things that really increase the value of the property. And you go out there and you get a tenant in there. Let's say the tenant pays $1,200 or $1,300 per month to live in this house. So you go out there, you have your $150,000 all-in cost of buying and rehabbing the property, and then you go to a lender and they appraise the property and realize it's worth $200,000. So what they're going to do is they're going to lend you about 75% loan to value, meaning they'll lend you about that $150,000 based on a $200,000 price. Now, why is this such a great method and a way that you can increase your net worth quickly? Well, look at it. If you refinance and take $150,000 back, you have your all-in cost back. So that repays your loan and any down payment that you put in. Meaning you could take, maybe you put $10,000 or $20,000 that you had saved up into the property. Well, now you get that back and you could do it again. You just have to go out and find another property. Okay, so let's say you have now took out a $150,000 loan. Now, based on the numbers that I run, based on the insurance that I'm used to paying and paying property tax, because a lot of these investment videos, they don't tell you about those fees. So we're talking an all-in impounded account of $1,100. And let's say you rented the property for $1,200 to $1,500. You're net positive $100 to $400 per month. And you have $50,000 of equity in the property, meaning your net worth has increased $50,000. You've taken that $10,000 to $20,000 back into your pocket so you can go out there and do it again, and you're still cash flowing positive. Now, obviously, I would recommend putting some of that into savings, because even though you have remodeled the house and you might have new plumbing fixtures, new roof, they don't last forever, even if they're brand new now. So keep a little bit in reserve so that you could use it in the future. Now, one thing I'm going to hear a lot is how risky this is. Now, there are risks, 100%, because when you're getting a hard money loan, those are generally 6 to 12 months loans. So you're going to have to get the whole process done quickly. You're going to have to buy the property and start rehabbing it immediately. You're going to need to get tenants in there quickly. But you do need to screen the tenants, and you need to make sure that they are going to be good, pay on time, good, clean people that are going to take care of your property. And you're only paying interest when you have a hard money loan. So you're not getting any of that principal pay down on the loan initially. Now, when you refinance it into a long-term loan, that's going to change, because now you're going to be making that monthly payment and your balance is going to be going down. But some of the downfalls are, if you didn't have all your finances in order, you may get to the end of that rehab and find out you don't qualify for the loan. That would be a huge problem. These are things you're going to want to make sure that you have set up before, because otherwise, best case scenario in that case, you would flip the property and maybe make $30,000 or $40,000 after expenses and things like that. So I hope that helped. I hope you find value in that. And like and subscribe down below, and we'll catch you on the next one.